Okay. Hi, everybody. Hi, Dave. What a great crowd. I think this is the most we've had. I know it's the most we've had in Portland. I'm Dave Sullivan, a shareholder at Perkins Co, Director of Business Development, and I'm going to try to arm wrestle our way through this scintillating subject, although initially I was thinking with such a big crowd and we got cameras and lights and a stage. This is the Kink studio. I was thinking maybe Bruno Mars or Beyonce. You guys are all here for that, right? You were hoping, but no. Who's here to learn all about taxes? Yeah, and who's here to learn about real estate taxes? Yeah, right? I mean, I'm serious, you guys. Accounting taxes are sexy again. I got a little joke on that. It's really true. The way our people think about it, they think it's sexy, and I agree with them. So obviously, this is a super hot topic. So we're going to address the new federal changes, the federal bill in tax law. First time we've seen a major change in 30 years. But I want a show of hands, first of all, for those with what you know about the tax bills relates to you and your business. Who thinks that you're going to end up as a winner? Raise your hand if you think you're going to end up as a winner. Okay, yeah. Kahlberg, he lives in Washington State. Who thinks that financially speaking you're a loser, might be a loser? Okay. And who doesn't have a clue? Still me. Yeah, it's still easily, yeah. Who doesn't have a clue? There we go, be honest, including some of our own tax people here, right? And Gary Reynolds, our chairman's not even sure, right, Gary? Okay, so you guys have come to the right place if you're here to try to figure out what's going on with the new tax legislation. And I must say that as I've done, our firm has done like a dozen of these presentations over the last couple of weeks, pouring through over 500 pages. And the truth is, what I've learned and what you'll find tonight is there may be cases where we're not sure. We don't exactly know what the implication is. So we'll be straight up about that because if you recall, that thing was whipped together in about a month, and at midnight or past midnight, they were scribbling in the margins in pen, trying to get this legislation through. So it's kind of a strange time for all of us. But we have done this for, I think, 5 years now, done these real estate connections, something like that. And we do the real estate connection because, one, it's the largest individual sector within our firm in terms of top-line revenue. We have over 20% of our business is involved in real estate, and many of you, our clients, are here, and we thank you for being here. But we also felt that it was important, given that the size and scope, we have over 20 people. In fact, Perkinators, Perkins people here, would you just raise your hand? So there's a lot of them in the back that didn't want to take up the critical space. I must say, we had one last night, and I said, if you're smart, what you'll do is sit or stand next to one of the tax people, and then you can whisper in their ear and go, what did they mean about that? Or give them your card and say, hey, can we have a one-on-one discussion? Because ultimately, that's what it's going to have to be, because I know all about facts and circumstance dictate everything, right? Exactly. Thank you. All right. So the other reason that we do the real estate connection is that we really want to stay and help the industry stay up on current events, topics, timely things like that. And we also want to, as we see tonight, try to foster community and a sense of belonging and a sense of being together and learn from each other and share with each other. So we thank you guys. Those of you who have been hopelessly devoted to this all these years, but we value your time and presence here. So just a quick moment about ground rules. We're going to hopefully go about 90 minutes. Again, we have a ton of material to cover, but we want to make sure before we advance into, we're going to go through some various subjects. Before we advance too far through those, we want to make sure that if something's super unclear, you can raise your hand. I will try to moderate that and keep things moving. If you go too deep in the weeds, we may just say, hey, let's address that later, and we'll talk about that one-on-one. But certainly before we move into the next section, feel free to raise your hand because we do want this to be an interactive discussion. And please stay afterwards. We have a ton of food and drinks, so we hope you'll stay when we finish up. And last but not least, I'm going to introduce our esteemed panel. And to my immediate left are their, yes, thank you, their pictures are up. So to my immediate left is Kim Spalding, and Kim is a senior tax manager at Perkins. She focuses in our legacy planning group and works a lot with our high net worth individuals, and we're delighted to have her. She has over 20 years experience, but is relatively new to Perkins, just having been with us about a year and a half. And she's a longtime Oregonian, and an Oregon State grad. Go Beavs. Okay. Where's Holem? Are you still here? There you go. Let's hear it. Go Beavs. And next to Kim is Tim Kahlberg. I assume that to most of you, Tim is no stranger. And if he is, we got a problem. He's been with Perkins for
a long time.
A long time. 3 decades, I think. But Tim is really one of the kingpins and one of the leaders of our real estate practice group that we love so much. And I know among a lot of you, he is really a go-to guy and one of the gurus as it relates to these complex matters of real estate. He is a graduate from Montana State University.
Go Bobcats.
There you go. And then to my left in the right corner is Brigitta Sutherland, and Brigitta is a shareholder on the tax side. Also works heavily with the real estate group, but also works with individuals and corporations. Has a tremendous amount of experience. And let's see, Brigitta, I always forget where you went to school. You went to the University of South Florida with a master's from American University in taxation. Correct. Okay, I got it right. That's on, by the way, these guys are on LinkedIn. Link in with them. Let them know you know who they are. Now, the other little fact that I pulled out that I honestly didn't know about you until today when I looked, but your dad worked for the IRS?
Yep.
That's crazy. So does that give you like some inside scoop and you can call and go, yo, just ignore that whole deal?
He retired a long time ago.
A long time ago.
Yeah.
All right. Well, you learned a few things, I'm sure of it. And last but not least, in the far right corner is Dan Eller. And Dan is an attorney and shareholder with Schwabe, Williamson, and Wyatt, which, by the way, is in this building. Perkins is in the building on 10 and 11, and Schwabe's also in the building. So I sort of look like if you need one-stop shopping legally and from an accounting standpoint, you got it, right? So Dan heads up the firm's business or tax team and is also a business attorney. He has multiple degrees, one from Portland State, Lewis and Clark, and University of Washington in taxation. So how about a hand for the panel before we get started, everybody? Okay, and my role now is to get off the stage and slide over to the side and drink a glass of wine. But in addition to that, I am going to pose a few questions to kind of get us started. Okay, and then I'll be available if need be to run down and bring the mic to you for your questions. So the first one is actually for Dan. And before we take a deep dive into the tax reform. One thing that I hadn't really heard about until this discussion was about the new partnership audit rules. And so what we'd like to do is have Dan give us sort of a background on that. What is it all about? What does it mean? And frankly, right now, why should we care about that now? So Dan, take it away.
Yeah, thank you, Dave. And thank you all for having me here at Perkins. It's my pleasure. The partnership audit rules are something that I've been talking about a lot over the last year or so. And in the last month and a half, no one wants to talk to me about partnership audit rules. Frankly, they didn't want to talk to me about that before anyway. The partnership audit rule changes came about at the end of 2015. There was a Balanced Budget Act, so if you hear me talk about BBA rules, that's all I'm talking about, the same thing. And the idea was that Congress had been tasked with going out and figuring out what's going on with audit rates, both for corporations and then for partnerships. Partnership numbers had been swelling over the years. Corporations had been staying about static, but corporations were being audited at about 24% and partnerships at less than 1%. And so the GAO did a study, multi-million-dollar study, and they came back and they found out that partnership tax is really complex.
Really? I had no idea.
Yeah.
What do we pay for that?
Yeah. And so because of that complexity, they believe that the audit rates for partnerships were a lot lower than their partners, so to speak, at the corporations. And so to bring it all together really quickly, the change that was essentially made is say, okay, instead of going out and auditing partnerships and having that filter through to the owners or the partners, why don't we just do the audit at the partnership level, and then if there's an adjustment, just send the bill to the partnership. So that will make things a lot simpler. Yeah. So let's say, Dave, that you went into partnership with Kim and Tim. And in year 1, they set up their partnership. Everything's going along very well. And then in, say, year 3, Dave, you've had enough of working with these two. You sell out to Brigetta.
Be lucky to make it 3 years.
So Dave sells his partnership interest to Brigetta. And now we have the 3 of them in a partnership. And then the IRS audits them in year 4. So in year 4 now, we have an audit, but it's back to year 1 or 2 when Dave was a partner. And so if there's an audit adjustment that leads to tax being owed, just a quick show of hands, is there ever an audit adjustment where it leads to a refund? Oh, yeah. Okay, so it leads to, in this typical situation, some amount of tax being owed. That tax will now be assessed in year 4, even though it relates back to year 1 or 2. So from Dave's point of view, that's pretty cool, because he sold his partnership interest that had this sort of unknown or latent tax obligation. Brigetta now looks at that and says, well, wait a second, now I'm going to have a third of this tax obligation. I wasn't expecting that. And so that's the general rule that we find ourselves into today under the new rules. And so the reason why I say that this is important and that we think about it is that even though these audits might not happen until 2-3 years from now, these rules apply now for tax years after the beginning of this calendar year. If we have these changes in ownership starting now and they affect a return that's audited in the future, we may be having these ownership changes, and it may make going back and squaring that up difficult. From there, the rules are so simple.
How simple are they?
So Treasury was faced with trying to come up with some regulations to explain that in some simple terms. And after about 1 year and 3 months, they did, at the beginning of last year, about this time last year, issue an initial reg packet that was about 280 pages in length. Unfortunately for them, there was a new presidential administration in that had come in with this 2-for-1 rule. Like if you're going to have a new reg come out, you got to take 2 away. And so the day after this reg packet dropped, about 1 year ago, they were told to take it back. And so we have been operating until about August of last year or June of last year, in this vacuum of, we can see what the statute says, but how do we know how all of this works? And so we finally get to a point where the reg packet comes out substantially the same, 280 pages, and it's still, we have a ton of questions. And Kim, you sent me some more guidance that came out in the last couple of days, another 50 pages. And so we're still in a point where, what are these rules and how will they apply? It is uncertain, but there's a few things that I can tell you with certainty. Any of your tax or your partnership or LLC operating agreements that you have do not contemplate this. If they even contemplate anything about audit rules, it's probably one sentence, and it'll say that there's some concept called a tax matters member or tax matters partner, and we should look to them if there's an audit. That doesn't apply anymore. There's a new concept called a partnership representative. That partnership representative, good news, can be anyone. So there might be some entrepreneurs in here that want to become fiduciaries. You can go ahead and start being a partnership representative, and you don't have to be a partner of the partnership. But with that responsibility will come obligations to the partnership, and defining what those are will become important. From there, getting back to this conundrum that I gave with the hypothetical, we might be looking nowadays to get these partners to agree on what will the agreement be if a partner sells. And so we can have them now indemnify their fellow partners if they leave, if there's a later adjustment that costs the partnership money. That can also be done amongst the partners. Dave and Brigetta could have agreed amongst themselves about that. But if Tim and Kim want to be protected, we should be building that in now. Beyond that, we can get into the weeds, but the reason why I say this is something that we shouldn't lose focus on while we're talking about what we'll talk about next, tax reform, is that this can affect us starting right now.
So let's keep the weed eater out of it. Or did you have a follow-up, Tim?
Well, I just had one quick question.
Yeah.
What should people do now, Dan, or should they wait for this additional guidance at both the federal and perhaps the state level?
So I'm a hammer and I see nails. Remember when they were introducing us, I'm the lawyer. So I would say that you should do something, and what that something would be is at least a stopgap measure to contemplate the change from tax matters member to partnership representative and who that will be, so that's at least in place. If you like the idea of some type of indemnification amongst the partners, providing for that. Basically, if you think that, and okay, so the thing, now we're this close to the weeds.
We're heading toward the rapids.
Heading
Be careful.
towards the rapids. There are several options that are available to you to avoid that outcome that I talked of having the partnership be subject to the tax. One is called a push-out mechanism. If you want to provide for that, you can. But there are a few things that we'd like to see be done just initially, just to get the pot right, if you will, while we're waiting for additional guidance. And it's as simple as amending the partnership agreement, which for many smaller size partnerships, not a big deal. If you have a big tiered partnership, maybe the amendment procedures will be difficult, but we'd like to see some action being taken and then this be on the radar going forward.
Great. Okay. Any before we move on, any burning questions on the audit issues? None. We move on. Okay. So let's jump from the weeds into the swamp or a raging river, and let's start with just kind of a big picture. Dan, if you could bring us up to speed, get us current on tax reform. How did we get here? Just kind of create context for us.
Yeah. So if we go back a year or two, say we go back 2 years. There was a lot of discussion about tax reform as being some big monumental change that might occur. The last time that we saw material tax reform was in 1986. That being said, there was a statistic that came out in about 2013 or 14 that said over the prior 10 years, there had been about 4,500 individual changes to the tax code. That was more than one a day over that period. So the tax code is always changing and evolving. But when we were talking about tax reform, we were thinking, is there going to be some big monumental change? And for folks in this room, the big change that was talked about on and off was taking 1031 and getting rid of it. And that, to me, would have been pretty monumental. As it is, and we'll talk about later, there was a minor tweak to 1031, but the concept of a 1031 like-kind exchange being totally gone forever, that was talked about with some seriousness. There was also talk about maybe going back and either eliminating S-corps or coming up with some type of a hybrid entity of an S-corp and a partnership with an eye towards trying to move those sorts of pass-through entities to that. Those were really big, big concepts. And then on the other side of the debate was, well, we could do some what we'll call tax reform in the nature of just changing rates. And so as our new administration came in a year ago, the discussion of tax reform started to pick up pace. And as we went into the summer, into the fall, we started to see more specific ideas about what would be ultimately come out. And frankly, as we got near the end of the year, there was a pretty strong pronouncement from the White House that there be some tax reform completed. And there was a strong push also in the House and Senate to get something done. And so it started to gain more momentum. There were a few limiting factors. One was how this would be passed. And so procedurally, there was a desire to get whatever the changes would be within a narrow band that would allow a vote to occur that wouldn't necessarily need support from both parties. And then beyond that, there was a desire to fit whatever these changes would be both within the budget and then within rules extending out in the future. And so tonight, when you're listening to the changes that you hear, you'll hear us talk about this one sunsets, this one is permanent. And when you hear that, it's like very, very likely that the reason for that is that if it was sunset, that was an item that helped to pay for the thing that will now be permanent. So when you hear that the C corporation rate goes to 21%, that's permanent. When you hear the individual rates will stay the way they are until 2025 or 2026, and then sunset, that is to pay for the other, one to pay for the other. So we were having these horse trades that were going on. And around Thanksgiving, we had a plan that came out of the House. It looks a lot like what we're at now, but different in some important ways. Then the Senate came out with a plan. And, frankly, at the end of the year, I'm pretty super busy. And I was kind of rooting for tax reform in 2018. But I got a holiday gift that was a little different than that. And so here we are. Yeah, you all, yeah. And so here we wind up with tax reform, as we will discuss tonight, all coming together right at the end of the year.
Okay, great. That helps a lot. And so, Tim, I think one of the most talked about provisions within the, there you go, yeah, within the tax code is the 20% deduction in business income for pass-through entities. And what can you tell us about that?
Absolutely nothing.
All right, we're done.
Oh, that's a great question, Dave. In preparing for this, one of my colleagues, Kimberly Woodside, came up with this great idea. Why don't you create a flow chart that will help you to describe how this works? And after 3.5 hours, I was still scratching my head, but I did come up with a flow chart. So there's no guarantees it'll work, but here you go. First of all, does everybody know what we're talking about here? The concept of qualified business income and the 20% deduction? Show of hands. Okay, most people. What this is all about is this was a provision that was intended to help on the individual side of the equation. As Dan mentioned, the corporate rate got reduced to a flat 21% tax. Well, on the individual side, as Kim will talk further about later on, we have a 37% top tax rate, and there's some other reform there. So that's quite a differential for individuals. So how did they address that issue? Well, they come up with this concept. We'll give you a 20% deduction against your qualified business income. In addition to that, one of the things that did go away effective 1/1/18 was the DPAD deduction, the domestic production activities deduction. Now, real estate owners, they really didn't care about that. But contractors, architects, engineers, a lot of other folks, they really did care about that. So that deduction is gone. So this kind of spun off of those rules and was added to the code. Its code section is actually 199 capital A, while the DPAD was 199. So imagine that. Congress is really creative when they do this stuff. So how does this work? What is the definition of qualified business income? Well, essentially, it's any trade or business income. So what it's not interest income, it's not dividend income, it's not capital gains income, those types of things. So it's things like your Schedule E, your Schedule C, your pass-throughs from your partnerships, your pass-throughs from your S-corps, income in estates, and trusts. So those are the items that we're talking about, the flow-through, which, quite honestly, a lot of real estate, a lot of professional services are structured as. So that's where a lot of businesses, that's why the IRS wants to start auditing those. The first question you have to ask as you're drilling down into this is, am I what's called a specified service business? Well, what the heck's a specified service business? That is the certain items that basically once you hit this threshold amount, and the threshold amount is essentially $415,000 for married or half that for single, once you get above that, forget about it. You don't get this deduction, period, end of story. You don't have to worry about it. If you're below that threshold amount, and you're below actually 100,000 less than that threshold amount, or 50,000 if you're single, so 315 or 157.5, you get the deduction and you don't have to worry about it. So that's kind of the way it plays for the specialized service industries. What are they? They are every one of us up here, accountants and attorneys. They are consultants. They are brokers. Okay, what's a broker? I see a lot of you out there going, oh shit, I'm a broker. Well, we think it's probably bad news and that you may not qualify, but we aren't certain for sure. This is one of those areas where we're going to need a lot more additional guidance, as Dave said. So we'll have to see how that plays out. What about construction management or contractors? They're okay. What about architects and engineers? Lucky for you, just like the D-pad, you're okay. You were a carve-out for those specialized services. So that's good news for your businesses. They get so broad, they talk about consultants, like I said, there's health, there's other ones, but they also talk about essentially any business that relies on the reputation and name of its employees or its owners. It sounds like a lot of businesses. Is that a developer? Perhaps. Don't know. Could argue either way. So there's going to need to be a lot of clarity. So that's just the specialized services. So let's say we're out of that. So we're like a real property owner or whatnot. We can get out of that and go to the next group of tests.
Hey, Jim, if you owned like a whole bunch of hotel properties around the world, would you fall in these rules?
Interestingly, no.
Oh, that's curious.
Yeah, isn't that? Great question, Dan. So here's the simple schematic. You see a lot of lesser ofs, greater ofs, head scratching. Let me try to boil this down to you so it makes a little bit of sense. Remember, I just said if you're under $315,000, you qualify for the deduction. Period, end of story. So that's good news. And that's true for any taxpayer in any business, as long as you have qualified business income. So we're always talking about qualified business income. Qualified business income is any business in a trade or business. Let's talk about real estate. Is real estate a trade or business income? Well, perhaps. Perhaps not. Why do I say perhaps not? Well, what about triple net lease property? Are you really actively managing, running that like a trade or business? Or are you just kind of clipping coupons and collecting your rent, your net rents after it's all done and depositing them in the bank? What we're thinking here is that we're kind of looking, and Dan, you can chime in if you think otherwise, but what we're kind of looking to in this aspect is more toward the net investment income tax rules. And in those rules, they talk about what's a trade or business. And in that trade or business, there is a discussion that they don't think that triple net leases would qualify and would be subject to net investment income. So to me, that feels like it may wind up outside of this ability to deduct. Thoughts?
We're struggling with this determination of what's active and what's not, and over the last number of years with the net investment income tax, and then with this, it's just getting to a point of what falls in and what falls out, or will we have a unified definition, or will we have a specific one? And on this one, I wish I could answer your question. I don't know.
That's kind of where we're at too. So back to the flow chart. As I said, if you pass everything, if you're under 315, if you have qualified business income, then the amount of deduction is one of two things. It's 20%. It's the lesser of 20% of your qualified business income, which you look to all of your separate trades or businesses, and this calculation theoretically is done for each trade or business that you're in. Query: is each rental property a separate trade or business if I'm a landlord and I own 10 different ones? Or do I pull all of those together and I only have one trade or business? Does it matter if I made the aggregation election as a real estate professional to pull them all together? I don't know. I mean, we still have a lot of questions in this area. But the good news is this doesn't depend on whether you're materially participating real estate professional or not. These rules apply to passive income, so you don't have to materially participate to necessarily get the 20% business deduction. So I keep sidetracking here. I guess I better finish off the actual flow of the flow chart. So it's the lesser of 20% of your qualified business income or 20% of your bottom line taxable income with one huge adjustment. That huge adjustment is your net capital gains. Well, what's in your net capital gains? Is a gain on the sale of real property in your net capital gains, perhaps? Okay, you're right. You don't get it on that. So what about that onerous depreciation recapture, the Section 1250 that your accountants always talk about, that, oh my God, you got to be taxed at a 25% rate instead of a 20% rate? Can I take is that 20% income? Who thinks it is? Well, you're smart. It isn't, because that's in your capital gain bucket. Only the ordinary income gains would wind up being in this, which is kind of huge when you start thinking about it and drilling down. So that's on the one side. So that's the overall limitation, and that applies to all taxpayers. Now let's say you're a taxpayer and you're over the $415,000. You're married filing joint over the $415,000. Well, then what do I do, and what is my deduction? Well, my deduction is the lesser of 20% of my qualified business income, so it's the same calculation that we just talked about, or the greater of, if this number is lesser, the greater of 50% of my W-2 wages paid, or 25% of my W-2 wages plus 2.5% of my end-of-year unadjusted depreciable basis in property. Clear as mud, right? You guys got that? So let me go through that again. It's the lesser of 20% of your QBI, or if it's lesser, these two tests. Well, how much wages do we have in real estate? Not a lot, right? But we do have quite a bit of depreciable basis, or hopefully we do, unless we got really old property. So that was the compromise. That was the Corker rule that was brought in to get his vote at the end of the day. I can't imagine that our president had much opposition to that one either. And interestingly enough, I mean, that sounds easy, but what do I mean by end-of-year unadjusted depreciable basis? So if you sold your property during the year, then that basis is out. That doesn't count because it's not there. It's got to be at the end of the year. If there's also the limitation they talk about, it's got to be depreciable. So land doesn't count. That's out. And there's also certain lives. Your depreciable basis, end of year, the unadjusted is your historical cost, right? Or if you had a 754 adjustment, stepped up the basis of assets, it would be that higher number, et cetera. So that's what we're talking about. So it's not bled down with depreciation. It's your original historical cost that you're carrying for tax purposes. But if that asset gets fully depreciated before the end of the year, then it falls off as well. So this is going to be an extremely complicated calculation to go through, and this is not done at the partnership or S Corp level. They pass it through to the individuals, and so all of the individuals are going to be responsible for all of this. So for those of you that got a K-1 that had all of these D-pad deductions, I can't remember which line item they were in, like 13 or 16 or something like that. But there was like all these different T codes that were down there. The partnerships are going to have to pass through, starting in 2018, a lot more information.
But I thought we were supposed to be able to do this on a postcard. Weren't we going to be simpler?
Well, if you're under 315,000, this might be simple. But if you're over, good luck. Yeah, good point.
And quick question.
Under the 315,000, if it's all real estate, you're still going through this calculation, right? The 2.5% of the adjusted basis and all that good stuff. that true?
I'm not sure. I don't think so.
No?
I think it's not true. I think.
When you guys are saying 315, do you mean 415?
Okay, so thank you. That's a great question. So the question is we're talking about 415, but we also just introduced 315, and we've thrown those out. Okay, so if you're under 315,000, there is no limitation. From 315 to 415 is a phase out of the ability to take the deduction. And it's kind of a 50% phase out as you progress through that. So that's the differential and why we're making the distinction. If you're under 315, you don't have that issue. If you're over 415, you have that issue. So I think the issue is on this calculation, it's only if you're actually above the 415 threshold or 315 when you start the phase out.
So is this a permanent change, or is this sunsetting?
Oh, thank God, I hope it's not permanent. No, this actually, great question. This actually does sunset as part of the individual provisions. So this will only be around until 2025 or perhaps earlier.
So aren't we all glad that,
By the time we figured it out.
yeah, right?
And just one other comment that I want to make on this. This is the federal rule. On state side, specific to Oregon, I think consensus is, just like we were disconnected with DPAD, that the current legislature will probably disconnect for Oregon for state purposes, which isn't a great answer, but at least it makes sense, I guess, if it can.
Can we start over when I asked, what's this all about? Right? Feel that, how many people in Congress do you think could explain this the way Tim just did? Over, under, 2, 1? Yeah. And I thought graphs and charts were simple, but you did a good job, Tim. So before we move on, any questions? Go ahead, Connie.
Jim, would you walk through, you talked about there being a lot of professional service providers in the room. Would you walk through a couple of simple examples, like maybe at a 200 level and a 500 level, how it goes through the chart?
Specific.
No real estate involved, just regular fee income for a service provider.
Okay. What type of service provider? Okay, so so let's say you're an attorney, and you have $200,000 of income. What doesn't count is did you get a paycheck? Did you get a W-2 if you're a corporate structure? That doesn't count as qualified business income. Or on the partnership setting, if you're that and you got a guaranteed payment, that doesn't count. So you've got to back out reasonable comp. And I think consensus is, and back to some of the partnership audit rules and whatnot, is that we may see a lot more review of what reasonable comp is. These rules also apply to sole proprietorships. So you get to deduct them there as well. But at that point, what's reasonable comp for a sole proprietor? Is it 100%? Is it 0? Or is it somewhere in between? Or what if I'm a service partner to a partnership and I'm doing services? Well, I'll just give up my guaranteed payment and I'll convert that to a special allocation of income in my agreement. Well, that should work, right? Or will the IRS pass rules and say, no, you've got to take a certain amount because that's abusive? So back to your question, I just sidebarred quite a bit, so I apologize. Back to your question, if I got $200,000, and let's just say it's not salary, it's not guaranteed payment, I got $200,000 of income. And that is also my taxable income. Or let's just say my taxable income is $100,000. So I got $200,000 of qualified business income, $100,000 of net taxable income. I've got no capital gains to keep it simple. 20% of the $100,000 is $20,000. 20% of the 200,000 is 40,000. My 20% of QBI is the 40,000. My 20% of taxable income is the 20,000. So I get a $20,000 deduction in that instance. Now, if I'm a lawyer and I'm over 415,000, I don't care. I don't get it, period.
My brain hurts.
Is there a difference if you take, as far as the impact of qualified business income, if the income is distributed via K1 through an LLC, like if each property is set up as an LLC, and that LLC distributes that income via K1 versus owning the property as an individual?
So the question is does it matter if I own the property for purposes of the qualified business income, if I own the property inside of an LLC wrapper versus I own it individually on a Schedule C? Does that make a difference? Correct? Yes. The short answer is no. It doesn't make a difference. The calculation is still going to work the same. I think the issue is, does what you're doing for that real estate rise to the level of what they're talking about as a trade or business? A couple of trade or business points. They're in our voluminous, I don't know how many pages the tax code is anymore, but nowhere in the code do you find a definition of trade or business. It is not defined anywhere. So it's just been based upon court cases and that kind of stuff. So that's a big question that we have. And I lost my train of thought. My second point
was, let's move on.
Yeah.
It's okay. Your brain was saying, I'm tired too.
Fair enough.
If you come back to it, plus we've got to stay on task. Joe, one quick one.
Okay. Just to go back where I think you were headed, could we say that someone who owned a piece of investment property and who outsourced their property management, are they not a qualified business income?
So the question was, and thank you for refreshing my brain. It's hurting right now, just like everybody else's. So the question was, if I hold a piece of property more akin to an investor, so I've got a duplex, maybe, and I hire an outside or a 20-unit apartment complex, and I hire an or a property manager that's managing that for me, and I'm not really involved in running it. Does that qualify? Is that considered to be a qualified trade or business? The short answer is it may. The long answer is I think there we've got to look at a lot of different rules and whether or not you as a taxpayer might qualify as a materially participating real estate professional and some of those types of issues. But again, this is something that we really don't know the answer to be quite honest.
Okay, one more, quickly.
Does end-of-year unadjusted depreciable basis include improvements made to the property?
Does end-of-year unadjusted depreciable basis include improvements made to the property during that year? Yes. One more question.
If I'm a limited partnership that does have QBI, do I get the QBI deduction?
So the question is if I'm a limited partner in the partnership that has QBI, do I get the deduction? The answer is yes. It doesn't matter whether you're limited, general, manager, non-manager, any of those. The one other thing I think I should mention quickly that I didn't, also included in QBI on top of what we talked about in terms of the trade or business is qualified REIT dividends. You get them on those. And income out of publicly traded partnerships. So those are two additional, but again, you're still subject to the overall 20% of taxable income. Now I'm done.
Okay, well, let's skip to something easy. Section 179, Brigetta, which the rules around being able to write off the entire cost of a business asset purchases. And so does this mean that I can essentially go or buy anything I want and then expense it during that given year.
So you think you can buy a building and just write it off?
Well, I already have partners who are willing to step up and buy it on my behalf. It's
Yeah.
beautiful. Thank you all.
Well, there
No.
were changes to the rules around Section 179 and bonus depreciation. However, it's not quite that liberal where you can write off your entire building. So let's first cover Section 179. That was, it used to be $500,000 of immediate write-off for personal property types of things. They increased that deduction to $1 million per year of immediate write-off, as long as your asset purchases in total are less than 2.5 million, or it starts to phase out once your acquisitions exceed 2.5 million. The other good news is that they allowed certain real property improvements to qualify for Section 179 expensing. This would include things such as elevators, HVAC, security systems. Now, I know that all of you lessors, landlords out there are getting excited about that, thinking that you're getting immediate write-off on that type of thing. Unfortunately, it only applies to trader businesses. There's that phrase again that it keeps on coming up. So that applies more to your tenants that are in the building if they have incurred those types of expenses, or a real trader business, let's say a manufacturer that owns the building. So those are the changes to Section 179. The other big piece was expansion of bonus depreciation. So bonus depreciation, which I'm sure many of you in the audience are familiar with, prior to actually the new date is September 27th of 2017. That will be an important date. Prior to that date, basically asset classes with a tax life of 20 years or less, you could write off 50% immediately, which was great. You know, everybody loved that. And originally, that was going to be sunsetting over the next few years. I think it was actually starting in 2018. It was supposed to start ratcheting down. Well, Congress gave us a present, and now it's 100% write-off. So the other good piece on that is for the bonus depreciation. I don't know if you recall, but there used to be 3 different types of leasehold improvements that could be subject to bonus depreciation. Those included, there are 3 Qs: the qualified leasehold improvement, qualified restaurant improvements, and then retail, thank you, qualified retail improvements. They got rid of those 3 designations. They basically rolled it all into something called qualified improvement property. And that qualified improvement property, you've probably heard of that before because that actually came into being in, I think, 2016, where they came up with this category called qualified improvement property, and it was available to people that made improvements, and it didn't have to be improvements that were subject to a lease. So if I own a building and I'm in that building and I make improvements to the building, I can now get bonus depreciation on those improvements. And it also, if you're renting to a related party, leasing between related parties, those before, for qualified leasehold improvements, if you were renting to a related party, they didn't qualify. Under the qualified improvement property, they did. But there was a catch on that for the qualified improvement property. You got the bonus depreciation, 50%, but then the remaining life was depreciated over 39 years. So now they got rid of those 3 Qs that I mentioned, and we just have one category, the qualified improvement property. And the intent, and that's the key word, the intent was for that qualified improvement property to be eligible for bonus depreciation. But what didn't happen was, while they were in the rush to write this bill, they didn't change the part of the tax code that basically converted that qualified improvement property from 39-year to 15-year, and thus eligible to 100% bonus depreciation. They got rid of the 39-year being eligible for 100%. They rewrote the code for that piece. So if you have 39-year property or QIP, it's still 39-year, but you can't take 100% because they didn't amend the code to basically wrap that into the 15-year. So what I'm trying to say here is that Congress needs to do a technical correction to the tax code to fix that error. So, and there's a few instances where we've seen that, but that's probably the biggest one that affects, the real estate community, is that you do have the ability now for this qualified improvement property. So that includes your qualified leasehold improvements, all those other things that used to be lumped into that 15-year life. They now get a 15-year life once this is fixed, and it will get 100% write-off, but Congress first needs to fix that. Now, the tricky thing is that I said, the bonus depreciation, those rules come into play starting September 27th of 2017, which we as, CPAs love when there's a tax reform package and they make one of the provisions, immediately, in place. So we're working on 2017 tax returns right now. And let's say we have a client that has a qualified improvement put in place after that magical date. What do we do with it? When is Congress going to give us, that technical correction or clarify it? Now, the one thing that I should mention is because I have had a number of clients that have had some significant, qualified leasehold improvements, those type of things, TIs, improvements to the property that have been put in service after that September 27th date. So they're thinking, oh great, I'm going to get that 100% write-off. I'll extend the return, we'll wait, we're going to get that 100% write-off. But the key on that is if you had a binding contract to start that work prior to September 27th, it still falls under the old rules. So it's 50%, 39-year, or 15-year, depending on whether it's QIP or the qualified leasehold improvement. So that's, and probably for most significant TIs, it's probably highly unlikely that you got a contract in place on September 30th and everything was, it could happen, and everything was settled and done and placed in service by the end of the year. It just seems, on most of the things I see, that the contractors don't get it turned around that quickly. So, does that make sense?
So Brigitte, I got a question.
Yeah.
Let's say I own a commercial office building and I started a TI, unfortunately, on September 20th. And it doesn't get done until January of 2018. Obviously, it's an 18 ad. Mm-hmm. What's my bonus depreciation percentage?
Oh, you're being tricky. That's a really good question.
Yeah.
Would it drop down to?
I wouldn't have asked it if I don't think I had the answer right.
Is it the 40%?
It's 40%,
It's 40%,
right?
yeah.
Ray with our BDO CASEG group.
40%.
Yeah.
Yeah.
So the moral of the story is it those old phase out rules that Brigitte talked about.
Yeah.
Remember, 18 was going to be 40, 19 was 30 to get rid of it of the 50% bonus. So those still apply to pre-927
Yeah.
for the start.
Yeah, really good point, Tim. So, and then the other question is, does this impact or change anything with respect to the tangible property regulations that came into play? I guess it's been 3 or 4 years now. About 3 or 4 years ago, and I'm sure most of you in the audience had experience in dealing with the tangible property regs and how the building was broken into components, and there's more liberalized expensing under repairs depending on how much of the building or that component was affected. All of those rules are still in place. Nothing changed with respect to that. So that's still around.
So my analysis in terms of determining whether I have to capitalize or I can expense it are still under what they were.
Play. Yeah.
And Brigitte, there were rumblings flipping forward regarding Congress talking about doing away with the 1031 exchange. Did that in fact happen?
No, well, it did not for the real estate group. So the real estate community, scored well on that one. 1031 is still around for real property. However, they did get rid of 1031 being used for personal property. So say, for example, like the auto industry, auto dealerships, or people that have large fleets of vehicles, that significantly affects them because they're usually using 1031 to get replacement stock. But where that does affect the real estate group is, let's say you are doing a 1031 exchange and you've had a cost seg done on that building, which we recommend, getting the cost seg to get that accelerated depreciation. But as you know, part of that cost seg is carving pieces of the bases of that building into shorter lives, 5-year, 7-year, and that technically is considered personal property. So when you're doing the 1031 exchange, there's the potential that that piece, the carve out of that personal property could be taxed. So that's where it's really important to, look at that, talk with the CPA, maybe get a cost seg done on the other property that you're getting. So let's say if there is tax that you're recognizing on that piece of personal property, if you're getting a cost seg done on your replacement property, hopefully with the accelerated depreciation, you can offset that. So there are strategies around that, but it's something to be aware of.
Before we move on, one other quick comment. Back to the depreciation, the bonus depreciation, probably something that people should think about. This is actually probably a question for all of our bankers in the crowd to see if they'd be willing to go along with this strategy. As part of the QIP, let's assume that Congress does get it fixed. If I'm building a building, a brand new building, I place it in service, and it's operational, and then I sign a new tenant into an open space and it's vacant, then that qualifies for QIP, right? Right. So I get the 100% bonus depreciation on that, right?
Right.
But if it comes online as part of the original building placed in service, so these are all my pre-leasing tenants, I don't think I get the QIP on that because it's part of the initial in-service building, right?
Yeah.
So would bankers be willing to allow me to build my building knowing I have tenants lined up, but I don't have leases yet for them?
Is there a banker in the audience?
Luther, would you allow that? Okay, but that's a key point to keep in mind. It's all these little subtleties in the tax law. Something to think about.
And that's the kind of stuff that can really trip you up if you're counting on that deduction, and then you bring your stuff in to your CPA, and then they deliver the bad news like, sorry. If we had talked about this beforehand, maybe it could have been structured a little bit differently, right?
What about original property rules for bonus purchased after 2020 or September 27th?
You're talking about the new or used?
Yeah.
Yes.
So that's a really good point, Ray. And one of the changes to bonus depreciation is for the 50%, it only qualified if it was new property. And now it qualifies whether it's new or used. So that's a really good point. However, the one caveat on that is if you do purchase used property, if you're purchasing that property from a related party, it doesn't qualify for bonus. Yes?
Is the bonus depreciation?
Oh, I'm sorry.
At what point would that kick in as far as the qualification if you have new construction and the pre-leasing? If you started construction and then you got a lease, would it kick in? Would it kick in then, or would it have to be after you complete construction?
I think it would need to be as after the building is placed in service, after you've gotten that certificate of occupancy for the building and it's deemed to be in service, then the lease has to start after that date. I think it can even be like 1 day after, correct?
Yeah.
Yeah. It just can't be on the same date.
Is the bonus depreciation available to tenants and
Yes,
property owners?
yes, it is.
Question.
In case you didn't hear that, the question was, is the bonus depreciation available to both tenants and the owners? And yes, it is.
Okay, so let's move along to some of the other changes that deductions, both on a personal and business side, that are worth noting, guys. Maybe, Tim, do you want to dive into the business side first, or?
My head hurts, Dave. Do I have to?
Yeah, tell me about it.
Very happy guy. Business interest expense limitation. How many people have paid any attention to this one? A few. Thank you. So what is this all about? Well, as part of the tax bill, one of the revenue side provisions was, let's put a limitation on interest expense. So again, I've attempted to flowchart this, and as you can see, there's a lot of arrows. At least I don't have anybody that's scratching their head on this one, so it's a little clearer.
And you have a smiley face.
And I've got a smiley face, which that's the goal, is to get there. The good news is that if you're a trader business and you're under, and this is only applying to interest expense in a trader business, so that's all we're talking about. We're not talking about Schedule A or investment interest or any of those types of things. This is only trader business interest expense. That term again, trader business. If you have less than 25 million, that's correct, in average annual gross receipts, it's a 3-year look back to make this calculation. If you're under that, generally you don't have to worry about this. It's only if you're over that. Well, how do I apply that? Does that apply to, does an individual partner have to look through to each partnership and pull their share of gross receipts, gross rents down to them as part of that calculation? Doesn't appear to us that that's the case. There is no pass-through. It's not like state apportionment rules and those types of things. So you look at it at each partnership level. You look at it at the individual level. There's some complex rules around that I'm not going to dive into in the interest of time. But needless to say, if you're under 25, if you look at any one of those and you're under 25 million, I don't have to worry about these tests. With a couple of caveats, pretty much specific to real estate, one perhaps interesting caveat, and that is if I'm a tax shelter. Now, does the audience believe that owning real estate is a tax shelter? Who believes? Okay, none of you. Well, you may want to think again. There's the tax code may disagree with you. Why do I say that? In the tax code, there's a provision where, under the tax shelter rules, if more than 35% of my losses are allocated to a limited partner or a limited entrepreneur, I'm a tax shelter. Got it? Now how many people think that real estate's a tax shelter?
I'm going to get a glass of wine. Right here, I need to drink.
So, I mean, there's a lot of rules. Dan, you could probably chime in here on this. I mean, they talk about, in the tax shelter rules, in this 35%, you've got to be truly a passive limited partner, right? So if you have management rights, do you see rewriting agreements? Are you worried about this at all?
I'm more worried about the interconnection of wanting to be passive for other reasons with fiddling with that to run afoul, to prevent this to run afoul of something else. So I think it's a little more complex than just the one decision.
Yeah. And perhaps we'll, as we get more guidance on this, and actually just yesterday the IRS announced its work plan, the 20% QBI deduction that I talked about earlier, as well as this provision, are top priorities for them. Interestingly, left specific to this provision, it's the anti-abuse rules. So remember how I said, well, if each partnership, well, okay, if I'm a fund, and if I had each partner or each property as a single LLC that feeds up into my fund, I'm only one taxpayer, I might get over the 25 million in gross receipts, right? So then I'd be subject. Then I'd have to go through. Then I'd have to worry about these limitations. But if I drop one of those down and create a separate filing partnership for each one, but maybe I have identical ownership, am I around these rules now? Because they seem to look at each individual partnership level. If that's the case, then I'm home free and I get to do it, assuming I'm not a tax shelter. But and it wouldn't surprise me for them to come out and say that if you have identical ownership, we're going to make you aggregate those. So there's more guidance to come in this area. But a couple of items to note here before we move on. I've got in there, if you're an electing real property trade or business, well, what's that? Well, that's your rental real estate. They're looking back for that definition to the 469 rules. And what is a real property trade or business? So it's construction, reconstruction, development, rental, property management, et cetera, et cetera, et cetera. So it's those types of businesses. If you fit within that, you have the ability, even if you're a tax shelter or over 25 million, to elect out of this and not have the interest limitation apply. But you have one big cost to doing that. The cost to doing that is that you have to elect ADS on all your real property. What does that mean? That means for qualified leasehold improvements, it's 20 years straight line, no bonus. 30 years for residential real property instead of 27 and a half. 40 instead of 39 for commercial property. So, I mean, that's something. Interestingly, though, this is why you may want to do a cost seg, because the short-lived property doesn't appear to be subject to ADS. And if you are subject, then just note that to calculate this, it's another adjusted taxable income. So you start with your taxable income, and you multiply it by 30%. But how you get your adjusted taxable income is you add back those items you see on the screen. So it's the 199 qualified business income deduction that we talked about earlier. It's your net business interest expense. So and this is net business interest expense. So if you have interest income, you get it netted against the interest expense. You add back NOLs. And then lastly, depreciation, amortization, and depletion. So that's pretty big for real estate. That's good news, right? Bad news is that last bullet point, that falls off in 2022. So that tells me that I want to try to bleed as much depreciation as I can before I get to 2022.
Now I know why you never leave the office. It's like Tim's like a mad scientist here, right? Figuring all this stuff out. It's fantastic. Any other deductions we want to address? I know that there were a couple things that Brigitte, did you want to tackle?
I think after, yeah.
Good.
Okay, so I'm going to now talk about, so there were some changes on the individual level as far as how much of business losses you can deduct. The general rule is that you can only deduct up to $500,000 of your aggregate business losses from all your various K1, Schedule C, and such. So put together a simple illustration here because I think it makes more sense when you look at it this way. So we've got somebody here that has some W-2 wages. The husband's the sole proprietor. His business had a $600,000 loss. And then they've got the W-2 wages from the wife, interest and dividend, short-term capital gains. But when you net all that together, their total income is zero. So then we run through their itemized deductions, what they are based on 17 versus 18. Kim's going to cover a lot of this as far as how the itemized deductions change, but most of you are probably more are aware of the fact that we're now limited on our state income tax deduction, so it's capped at $10,000. So that's the primary difference between the itemized deduction between those 2 years, and Kim can go over the other items that change significantly when she talks about that. So then we get to the comparison between 17 and 18. So looking at 2017, under current, or I guess it's no longer current law, under 2017 law, they had adjusted gross income of 0. They have their personal exemptions, itemized deductions. The taxable income was negative $75,000. And then they get their refundable child tax credit of $2,000. Under 2018, they actually have adjusted gross income of $100,000. That's because the Schedule C losses, which were $600,000 and wiped out all the income, you're only allowed to take up to $500,000. So that $100,000 left over is a net operating loss that carries forward to 2019. So in that instance, we're at $100,000 for our AGI. We've got our itemized deductions of $27,000 versus the $59,500 that we had in 2017. Our income tax is $8,380. The child tax credit did increase, so net is $4,380. So between the 2 years, we see a difference, increase in tax of $6,300 because of that limitation.
I'll point out real quick on that child tax credit, that's only if your child is under age 17. So just when the college tuition costs kick in, they take away the child tax credit.
Well, you don't need it anymore once they're over 17, right? So that was business losses. Those are, you're only allowed to take up to $500,000 in a year. Whatever you don't use creates a net operating loss. So then we have net operating losses, and they didn't touch those, did they? Well, yeah, they did. There's limitations on those as well. The first thing to note before we dive into the numbers is for net operating losses, if you had a net operating loss on your individual return, you were allowed to elect to carry it back 2 years, or not elect, but you first carried it back 2 years to apply it against prior years if you had the income to offset, or you made an election to just roll it forward. Now you no longer have the option of doing the carry back. It's only a roll forward. So that's the first change. So in this scenario here, we have the husband that's a sole proprietor, wife, employee. They have 2 kids. So in 2018, the wife has wages of $400,000. They have some interest and dividends, and the husband's Schedule C generated a $900,000 loss. So their total income that year is a negative $475,000, but then things rebounded with the business in 2019, and he generated $99,000, so $524,000 of income in 2019. So let's see how this plays out. Their itemized deductions, because of the loss of the state income tax or the fact that it's capped, their itemized deductions are only $22,000, so they're actually going to be taking the standard deduction, which I think we're going to be seeing more and more of because of the fact that we don't have that state income tax deduction as high anymore.
This is where the promised simplification was coming from.
Oh, is that the simple part? Yeah. So
how
yeah,
it got-
standard
Is this,
deduction.
is this the postcard filer?
That's how it got simpler, right there.
Yeah, yeah. So in 2018, their adjusted gross income on that first slide, it was like negative, I think 475 or something like that. Well, it's really only a negative 75,000 because remember, your business losses are limited to 500,000. He had losses of 900,000 in that scenario. So going through the math, and I won't take the time to walk through that, but it's actually negative 75, and there's a $475,000 carryover that goes to 2019. So then the rest of it, they get a child tax credit of $2,800. The refundable child tax credit is $1,400 per child. If you didn't have any income tax, you still get that $1,400 that's refundable. So then rolling into 2019, the NOL from that excess business loss, that $475,000, you can only take 90% each year of your NOL. You can't use all of it. Even if you have enough income to offset all of it, they've capped NOL deductions at 90%. So that means that their adjusted gross income is $74,000, and they still have $25,000 of NOL carry forward to the next year. So yeah, simplification up here. But any questions on that piece? I think everybody's just sort of brain dead after all this.
We're wearing them down.
I know.
Is it Kim's turn?
Well, let me just go just a few other high-level business deduction changes. Something that you've probably heard of is entertainment deductions. Let's say you buy Blazer tickets to take, clients, business associates out with. Entertainment is no longer deductible at all.
What?
Yes. Bummer.
I have nothing to live for then.
I know. Another one is a lot of people will, bring in lunches for employees. You bring in meals. Those used to be fully deductible because they were for the convenience of the employer. We do this all the time during busy season. We bring dinner in 4 nights a week because we want people to stay in the office and keep on working. And so get a full write-off for that. Now that's limited to 50%. And that deduction, I think starting in 2026, it's not deductible at all. So a few changes on the meals and entertainment side. I think that covered
So Perkins is going to be serving ramen from now on. That's my solution to that.
Not quite yet, but the Christmas party, any type of social event like that, the office Christmas party, if you do a summer picnic, if it's for the entire company, that is still deductible.
But every meal's a party at Perkins.
I know.
Yeah, right?
Yeah.
Okay, are we ready for Kim?
We are.
Okay, all right, a quick quiz. Who remembers Kim Spalding? Raise your hand. Where did she go to school? Oregon State. You guys get yourself a wine or a free dessert before you leave? Okay, very good. How long has she worked at Perkins? Year and a half. You guys are good. All right, everybody, Kim Spalding, please.
You guys are really good. No, we're going to actually breeze through this part really quick
Hold
to
it up a
catch
little
up.
closer for-
We're going to breeze through this individual part real quick to catch up on some time. For the general sense is that the itemized deductions are being definitely limited, and taxable income for people is going up. But where that's being offset is in the rates. And so the highest rate was reduced down to 37%, and that doesn't kick in until $600,000. There's also, you'll see in that comparison between 2017 and 18, the lower rates go up for to a much higher level of income. So in 2017, where we used to get to the 25% rate below 100,000, now we're not kicking into that. We get the 24% rate up to about 300,000. So we've all heard about the state tax deduction cap of $10,000. There are some states working on a workaround on that, more to come, to where we can maybe get a deduction, like a charitable deduction. Miscellaneous itemized deductions have been eliminated. Anything else noteworthy
So
on
that
there?
means they can't deduct our fees anymore.
Yeah, all of our fees. Yeah.
Investment, your
Dan's
brokerage.
Dan's estate planning fees.
Estate planning fees, investment fees.
The good news is charitable deductions remain. They actually increase the amount you can deduct up to 60% of your gross income. I think over the last year, a lot of people were worried there would be severe restrictions on the charitable, so that's good. The prediction is that about 94% of Americans are going to be taking the standard deduction. So there you have the simplification.
And then what else do we have?
Oh, the mortgage interest.
state
Let me
mortgage interest,
just comment real quick on the mortgage interest. So that interest used to be deductible on up to $1 million of mortgage. That has been scaled back to $750,000 for mortgages entered into starting this year. So if you can continue deducting interest on the full $1 million prior. The big change is the home equity, that you can no longer deduct interest on home equity. combined.
But you're still allowed to have your primary and an additional residence, like the old rules. They didn't do away with that.
Yeah, originally they were talking about having it just be on one home, and they negotiated to allow it to be more than one.
Alimony?
Yeah, so alimony, they negotiated on this one too, and now if you get divorced starting next year, the alimony is not deductible. But for contracts entered into in 2018, you can still deduct the alimony.
Okay, got 11 months.
Yeah, thank you for that
Oh, that's
reminder.
great. Don't tell my wife I asked that question whenever you do. She's not here tonight.
One thing I hear on this point is, as this was rolling in and there was discussion of what were these changes aimed at blue states versus red states, and that conversation will rage on over wine later. One thing that was asked very early on with the limitation on the itemized deduction of $10,000, especially in Oregon where we have a high income tax, is would we, even with the compression in the rates, would we all in Oregon wind up in a worse position? And it would appear for many and maybe most people that now you'll fall out of the AMT for the higher wage earners. And so the thing that was pushing you into the AMT often was the state and local tax deduction. And so that's where we're thinking that even though when you look at us compared to a state without an income tax that isn't subject to the $10,000 limitation, there are other reasons why you'll wind up being close to where you were or maybe a little bit better off.
And then a little bit on gift and estate. Are you going to dive into that quickly?
Yeah, we are. So there's a big change in the estate and gift area in that the exemptions for estate and gift tax have doubled to 11.2 million. So for a married couple, that would mean that they would need to have an estate and assets of over $22 million to be subject to the estate tax. They could also gift away that amount during their lifetimes. So that's a big change. Now you may be out there wondering, well, I've got less than $11 million, so should I even bother? Is there anything that I should be thinking about doing? And there's some important things to think about. The main one is that this sunsets after 2025. So the estate tax exemption goes back to its original levels then. And you also have to remember compounding and growth. So you may have an estate now of under 11, but in 10 years that could be double. So it's really a use it or lose it opportunity. We think that it's definitely worth thinking about. Yeah, so the other, thank you, the other, thinking about planning, yeah, lots of planning. Yeah. One of the important things to also remember is that Oregon and Washington's exemption remains very low at about $1 and $2 million. The key with that is that they do not track your lifetime gifts. So anything that you're giving away during your lifetime is not going to be subject to that state estate tax. One thing that did not change with this new tax law is the step up in basis that you get for income tax. We were all wondering whether that was going to happen. So when you're thinking about whether I should be giving away assets, it's really important to think about what assets you're giving away. Whether you want to give away that highly appreciated low basis asset may not be the best move when if you hold it until you die, you're going to get a full step up in basis and not have to pay so much income tax.
Okay. We're running short, but do we want to dive into the C Corp and the decisions regarding that? Dan, I know you've got a few remarks on that. I just want to make sure we're respectful of people's time.
Yeah, I would think that when the C Corp rate was known to be 21%, probably the biggest number of calls that I had at the end of last year were, should we all in on C Corp now? The idea being that we're hearing that the rate is 21%, so that must cure all these problems here. It turned out the answer is usually no. And the reason for that is that that's fine for the C Corp. It'll have that tax rate. But then for the owners, when the income comes out in the form of a dividend, especially in Oregon, you're just going to add back in all the Oregon tax on the dividend and the income tax on the dividend that's going to push you up above this anyway.
So when should I be a C Corp?
I have a checklist. Would you like that?
I would say
Mail it.
if you're going to keep the cash in the company for a long period of time, and also if you're a qualified small business stock and you get to exclude some of the gain when you sell it. I mean, there are definitely times when a C Corp structure makes sense. Question in the back?
The one other point, though, to keep in mind on the C Corp, it's a 21% flat tax. So remember how we'd play, I shouldn't say play the game, but we'd play the game.
We plan.
We'd plan, thank you. To manage taxable income at $75,000 or less, because those brackets were way lower and we wanted to not pay all of that tax in the corporate side, so we'd essentially manage the amount of taxable income in the C Corp. Well, now, from $1 to $75,000, you're still paying this flat 21% tax. So keep that in mind.
That's a good point. I was actually, just before this presentation, I was meeting with a client to go over their C Corp return, and they said, well, what's the impact for me in the next year? And I said, well, it actually goes up to 21%, and this was somebody that we always did that planning to probably keep their income under $50,000, so they were only paying 15%. And so he told me, so you're saying I basically just got a tax increase? And I was like, yes, unfortunately. So
on the positive side, though, the personal service tax rates and those which were at 35 are now at 21.
right.
Kimberly, did you have a question? Or somewhere?
About the carried interest. How about profits interest?
We did not address that, did we? Good question. So, you want me to take that, or anybody else want to? My head still hurts, though. So they did. There was a lot of. This is another area where there was a lot of rumbling about changing and doing away with. Doggone it, these people should not get to pay capital gains rate for service income. That's basically what it boiled down to. And quite honestly, it was primarily directed at the Wall Street hedge fund managers, because they would buy and sell businesses and they'd structure it so that they'd basically get all of their fees in the form of capital gain, pay 20% and then plus their state rate, and be happy, very, very happy, because they just got a lot higher after-tax return on that. Well, they were talking about doing away. This has been something that's been talked about forever, it seems like, at this point in time, and there's been threats, but it hasn't ever come to fruition until now. And they did tweak the carried interest rules. So to be able to get that long-term capital gain treatment, you have to meet two things. One is you have to hold your partnership instead of for 1 year, for 3 years now. Secondly, if there's a property inside the partnership, it has to also be held and meet that 3-year holding period. So you got to look to both of those. So this is something that, you don't necessarily think about, but in even service businesses and other types of businesses or startups where you're issuing profits interest, those kinds of things, you need to maybe think about this if your goal is to try to get long-term capital gain treatment. Yes, question in the back.
Does the 3-year meter start when you close on the dirt or when you place the building in service if it's a construction project?
That's a great question, Dan. So the question is, did everybody hear that question? It's when does that clock start ticking on the 3-year holding period? The answer is multiple times. So for the dirt, it would start when you'd close on the land, right? But I think when you hit the improvements, it would start once those improvements are in service. So you might have some. And what happens is if you don't meet the 3-year holding period, it gets classified as short-term capital gain as opposed to long-term capital gain.
Do you guys, I know we're short on time too, but question, go ahead.
I was just going to ask, do you have to have title to the property? So if the LLC is set up, you initiate a lease option, occupy the property, and then purchase the property. Does the timeline begin when you exercise the option and take title to the property, or when you begin occupying the property under the lease option?
Dan, you might want to chime in on this one too. I'll give you my gut reaction. Isn't that a good way to pass the buck? So the question is if you have an LLC and you basically have an option to purchase the property, so you haven't really closed it, but you've put like hard money down and you have an option to purchase it, and you're going through due diligence and that kind of stuff. When does the clock start ticking? Does it start ticking when I enter into the option agreement, or does it start ticking when I actually close on the property? I think tax law would say it starts when you close on the property, because that's when you now have the benefits and burden of ownership, as opposed to when you would enter into the option agreement. Thoughts?
My recollection, it's tied to ownership. And so if you have a true option that's respected as an option, you haven't closed on it yet, you don't yet own the property. So you haven't yet started the clock.
Do we have time to go ahead?
We have time for what?
Well, I'm just wondering about the implication, what we discussed this afternoon in terms of the city of Portland, and whether or not we want to dive into the implication to the real estate folks.
Yeah, I think this is a big enough deal that it's worth spending a couple minutes. Dan, I think as in your role and where you're at, you're probably best suited to field this one.
Yeah. So in October of last year, the city of Portland made a change that said that to the extent that a partnership entity has in place a 754 election, and that causes basis to change upon an event that would cause a change. So for example, an ownership change. That still works for federal law, works for state law, but the city is essentially going to ignore that step up, if you will.
So basically, on the step-ups, if it's connected to real estate, you get the depreciation deduction. The city is saying that that depreciation deduction is related to the individual investor. It's a partner-level deduction, not the partnership. So they're disallowing that deduction on city-county returns. We actually had somebody call the city for clarification, and this is not, in their eyes, not a new ruling. They issued this administrative ruling to clarify that that's always been their position, though we've never really seen, except maybe I heard of one instance where the city may have questioned it, but it hadn't been disallowed. So this is something that they are now looking for, and their intent is to not allow these 754 deductions on city-county returns, which can have a huge implication.
Yeah, the complexity is, well, first off, disconnecting on one item as opposed to anything else is a departure from the city, what it's done tax-wise for a long time. But then when you think about the complexity for the folks here to my right and to all of you, on that one specific item is curious. So getting back to this point of what's going on now, so this has been like a ruling, if you will, since October. They wanted to just make it, that's the policy. There's been enough comment back from the public to say, slow down, let's have some discussion about this, that at the most recent time that I checked in on it, that they were going to be doing a public hearing at the end of last month or the beginning of this month. It still hasn't happened that I know of. So if it happens in the next few weeks, it will likely get a lot of comment. I know that the State Bar tax section of Oregon is looking at it just in terms of their unintended consequences. We're not able to make a policy decision. We can't say that this law is good or bad, but we can say here are some other unintended consequences. And I can say just from looking at it from my perspective, it creates a lot of complexity from a compliance point of view that now all of a sudden we're going to have a whole other set of records or books to account for one specific change in one city and county. That seems a bit over the top.
Well, I think the other thing that goes without saying is the depreciation would be disallowed, but what if we sell the property?
Right.
What if I had a partner that owned a commercial building in Portland and it had appreciated substantially? You guys worked your magic, you got a valuation, got this nice step up, I got rid of my income tax problem, or I have a lot higher basis to depreciate. for federal and state purposes, but I don't have liquidity within my estate, so now I need to sell the property. So now I have a lot lower basis and a lot higher gain in the city of Portland to pay to. That sucks. More to come on that one, but we wanted to make you guys aware of that because that's, in my mind, that's a biggie.
Yeah, definitely.
And it came as a total surprise to me.
Yeah, it sort of slid in under the radar, so it was interesting.
Just quickly along the lines of the difference in basis and step-ups. So for a long time, people have been wanting to get assets outside of their estate for estate tax purposes. Now with the increased exemptions and high tax rates, I want to mention that you can own something for income tax purposes and not own it for estate. Well, the reverse is true. So you can own something for estate tax purposes and not for income tax purposes. So some people are setting up trusts in states that don't impose estate tax, but still retaining them for estate tax purposes and getting a step up in basis. People are also looking at using trusts to have the ability for flexibility to exchange low basis for high basis assets or the reverse. So a lot of different planning opportunities.
So moral of the story is to come and see people like you, Dan, others involved in that arena. That's outside my bailiwick.
So much for simplified tax, right? Yeah, so guys, I want to be respectful of time. Do we have any burning questions? And again, I think the panel will stay around afterwards and as best they can answer your questions, but anybody for the group, good of the order? If not...
Kimberly, Trina, did we miss anything?
We missed a lot, okay. Tip of the iceberg. Yeah, the lesson, as you said, is don't go it alone, and I guess the attorneys and accountants have careers for a while longer, right? But you guys, thank you so much on behalf of Schwabe, Williamson, and Wyatt, and Dan, and the panelists, Kim and Tim and Brigitta. Thank you all on behalf of Perkins for joining us, and you've been very, very patient, and I hope you've picked up a nugget or two. There's a ton more to learn, but don't do it alone. And please stay afterwards. We have more food and drink and socialize if you're able to. And we hope this is beneficial. If you have other topics that you would like to have us cover, please let one of us know, that one of the Perkinators know, and we'd be happy to bring it to the group. So thank you all very much for coming, and be safe.